Hello, everyone. This webinar is brought to you by Summit Strategic Capital Management in Fort Smith, Arkansas. We are a small boutique wealth management firm owned and operated by Paul Wills. We are active investment managers and believe buy and hold investment strategies benefit the financial industry but can cause great harm to individual investors. Dr. Will's background in ear, nose, and throat surgery has taught him the logic of evidence-based medicine. Since retiring from medicine, he has become a registered investment advisor and now uses evidence-based decision-making to bring science to his investment management. The debate within the investment community continues about whether price movements in securities are predictable. Two competing books represent these two theories. A Random Walk Down Wall Street by Burton Malkiel, who's a Princeton economist, argues that price movements are largely random and investment managers cannot outperform the major indices. Another book argues the opposing point of view, written by Andrew Lo and A. Craig McKinley, A Non-Random Walk Down Wall Street. A paper written by Andrew Lo in the Journal of Finance says, technical analysis has been part of financial practice for many decades, but the discipline has not received the same level of academic scrutiny and acceptance as more traditional approaches such as fundamental analysis. One of the main obstacles is the highly subjective nature of technical analysis. In this paper, a systematic and automatic approach to technical pattern recognition using non-parametric kernel regression was applied to a large number of U.S. stocks from 1962 to 1966 to evaluate the effectiveness of technical analysis. Several technical indicators provide incremental information. www.nber.org, Andrew Lo wrote a paper in the Journal of Finance in 2000, Foundations of Technical Analysis, Computational Algorithms, Statistical Inference, and Empirical Implementation that supports this thesis. So where do you go to get objective advice about your investments? Investors today are being fed lies and distortions and are being exploited and neglected, says Arthur Levitt, former chairman of the SEC. In the wake of the last decade's rush to invest by millions of households and Wall Street's obsession with short-term performance, a culture of gamesmanship has grown amongst corporate management, financial analysts, brokers, and mutual fund managers, making it hard to tell financial fantasy from reality and salesmanship from honest advice. We would like to tell you the story of Summit Capital. We provide a broad range of integrated portfolio solutions that free our clients from the day-to-day task of asset management so they can focus on their core businesses. We offer a proprietary market timing discipline that creates an innovative entrepreneurial approach that allows our clients to shadow trade Dr. Will's portfolio, provide fiduciary oversight, and rigorous investment and risk management. Each day, our Wills Index Market Scorecard combines over 50 market indicators into a single number. This number is then analyzed and compared to a neural network and intermarket analysis predicted next day high and low software algorithm and ETF or individual securities selected from our screening of the global marketplace. Great emphasis is placed on general market direction and conditions, bullish, neutral, or bearish. A noted trading educator, Van Tharp, says, people do not trade the markets, they trade their beliefs about the market. Here are some of Van Tharp's current beliefs about the markets. One of my primary beliefs is that the market tends to run in 15 to 20-year cycles. These cycles have been called primary. Right now we're in a secular bear market that started in 2000. These cycles are characterized by changes in the price-earnings ratio of stocks, not the prices of stocks. Thus, in secular bull markets, the price-earnings ratio for the S&P 500 tends to go up. If the price-earnings ratio goes up from, say, 8 to 40, it is very likely that prices will go up as well. The last secular bull market started in 1982 with the price-earnings ratio of about 7 and continued until March of 2000, when the price-earnings ratio reached about 44. In 2000, a secular bear market started. It should run 15 to 20 years and end sometime between 2015 and 2020. So far, the S&P 500 price-earnings ratio has dropped from about 44 to 15.17, which is close to the historical average. By the end of a secular bear market, price-earnings ratios are usually in the single digits. Secular bear markets and the economy. Sometimes there is no relationship between the economy and what's going on in the secular market, bear or bull. More than once, secular bear markets have occurred when the economy was doing fairly well. The current secular bear market, however, corresponds to the worst set of fundamentals ever, and some of those are just now kicking in. Here is a short list. Number 1, recession. Except for the fourth quarter of 2003, we've been in a recession since 2000. That's essentially a 12-year recession. Number 2, debt. Number 3, graying of the population. For many years, the baby boomer generation has been putting money into mutual funds to finance its retirement. Mutual funds need to be nearly 100% invested in stocks, so this has supported the whole U.S. stock market. However, a sea change is about to occur. One of the big changes is the flow of money into ETFs and ETNs and out of mutual funds. Send me an email and I will send you a PDF file on the death of mutual funds. Mutual funds have a record of underperformance, hidden fees, higher income tax consequences, and lack of investor control. Number 4, status of the U.S. dollar. For decades, the rest of the world has considered the U.S. dollar to be the world's primary currency. Currency reserve status meant that effectively, we could count on other countries to finance our debt. But that can only last so long. I guarantee that some point in the future, the US dollar will no longer have this lofty status. It's only a matter of time. Number 5, status of other key currencies. There are actually 2 other currencies that are even more likely to collapse than the US dollar, the euro and the Japanese yen. Number 6, derivatives. Remember in 2008 when the world lost about 30% of its wealth in about a year due to the subprime meltdown? Well, that situation hasn't gone away. Big banks still hold a lot of derivative positions. In fact, those derivative positions total much more than the net wealth of the entire world. JP Morgan, for example, has about 93 trillion US dollars in derivatives. What does that really mean? No one but those in the know at JP Morgan can say for sure, but I doubt it's good. By the way, that position is more than the estimated wealth of the entire world. Number 7, the interdependency of the entire world economy. Lastly, we have to talk about the dependency of the world's economy. If the euro fails, it affects the entire world. If the US dollar fails, it affects the entire world. When a derivative meltdown occurs, it affects the entire world. We are now that interdependent. All of these crises affect everybody. Do you know what a hedge fund is? An aggressively managed portfolio of investments, advanced investment strategies. The important part is you can go long or short derivative positions, and almost everything available in the global marketplace is available in the hedge fund. Hedge funds, an aggressively managed portfolio of investments that uses advanced investment strategies such as leveraged, long, short, and derivative positions in both domestic and international markets with the goal of generating high returns, either in an absolute sense or over a specified market benchmark. What are ETFs, exchange-traded funds? A collection or basket of securities that typically tracks a specific market index. They're similar to index mutual funds, and they possess trading flexibility of individual stocks and are listed on major exchanges. What are ETNs, exchange-traded notes? A senior, unsecured, unsubordinated debt security issued by an underwriting bank. Similar to other debt securities, ETNs have a maturity date and are backed only by the credit of the issuer. What is the difference between an ETN and an ETF? ETNs are structured investment products that are issued by a major bank or a provider as senior debt notes. This differs from an ETF, which consists of an actual security or sometimes commodity or currency derivatives such as futures, forwards, and options. When an investor purchases an ETN, he or she is purchasing a debt product similar to a bond. When an investor purchases an ETF, he is purchasing an asset like a stock or index. Because ETNs are backed by a bank with a high credit rating, they are pretty secure products. However, the notes are not without credit risk, just a lower level. There are a number of studies which have shown relative strength to be an important factor leading to portfolio outperformance. Summit Capital embraces these studies and in fact utilizes this as a selection factor in a number of portfolios. Dorsey, Wright & Associates has been one of the leading firms in relative strength research, and they have just produced another white paper, which I have added to the reference page. The paper, Tactical Asset Allocation Using Relative Strength by John Lewis, CMT, is one of the first papers to discuss the use of relative strength or momentum, as it is sometimes referred to as, with baskets of ETFs. See this link for the source of the quoted return summarized below from Portfolio Cafe. Testing was done on 100 ETFs spanning a variety of asset classes and ETF sponsors. The universe composition included traditional asset classes as well as commodities, currencies, and even inverse ETFs. Portfolios were constructed containing 10 highly ranked ETFs. In order to determine if luck was involved in the selection process, numerous portfolios were created and Monte Carlo analysis was conducted to test the robustness of the selection process. This was done by randomly selecting from among the top quartile, the final 10 constituents. Tests were ran for the period December 31, 1999 to December 31, 2011. The results. The 10 ETF portfolios outperformed the S&P 500, the 60/40 Balanced Index, and the Barclays Aggregate Bond Index 100% of the time, even when securities were drawn at random from the top quartile. The minimum return was 121.60% versus the S&P 500 return of negative 14.1%. The median return was actually 197.4%, which was also close to the average return of 198.80%. Other conclusions? Their studies showed that relative strength performed best when intermediate time periods, 3 months to 12 months, were used. Relative strength does a good job of managing volatility because of its adaptive nature. When volatile asset classes are declining, it might rotate to less volatile asset classes like bonds and currencies. And perhaps the most important conclusion that can be drawn from this is that it is certainly possible to achieve better returns from those offered by the standard broad-based benchmarks. One important concept you may not be familiar with is on and off for the ETNs or ETFs. Fisher-Gartman actually has these available in stockcharts.com where you can graph this. Since the 2007-2008 global financial crisis, securities trade far more with correlated assets. In other words, the difference between asset classes is narrowed rather than gotten together. So, you have a flight and think the world's getting better, you have a fight in the securities and risk-based assets, or you can have a flight to safety. This is a good paper to review on our reference sheet, Risk On, Risk Off, the full story, and I have a series of articles that detail exactly what this concept means. We have available a summary sheet, ETFs, ETNs, if you request it in an email form to pwills@sscmonline.com. A couple rules for trading leveraged ETFs. Again, this is on our reference sheet. If you go to the end of this presentation, it will be available to you. The biggest point is that have trading enough volume that they're liquid, 100,000 shares per day. You don't want to just buy and hold these. Your holding period is going to be from 1 day to 6 weeks, usually not longer than that. Always enter your stop loss. So when you enter the trade, you know what your targets are, you have your fundamental and technical reasons lined up, reasons for taking the trade, use your stops, and you have your profit targets in mind. Keeping a trading notebook and knowing exactly why you entered the trade. The way we score our trades, or did we follow the rules? A trade is successful if we followed the rules. If we violate one of our rules, then we mark it as an unsuccessful trade, whether it made money or not. You can trade with using good tight stops and good money management, and you have a number of losses and still be a very profitable trader. The important point is to trade off the benchmark chart, not the ETF chart, or you can find a very well correlated asset and be able to trade off that chart as well. I'm a technical trader. We have some software that may show some of the fundamentals, but technically off-the-charts driven strategies are what works for us. We'll show you one parabolic spike in just a minute that shows you event-driven strategies work well with the leveraged ETFs. We had a great experience with silver last year, finding a parabolic spike and being able to enter near the start of that spike and exit and actually catch the short side of that trade. So be sure your fundamentals and technical are in agreement. Here's the chart I was talking about from the agriculture index. It shows the parabolic spike with corn right now. A little pullback, and I don't know where this will finally end. Will it end at the top of the blue line or beyond, and spike beyond or retrace all the way back down? We trade each day with what we see, not with what our prejudices are or what we think might happen. What we see in front of us on the screen. If you can learn to do that, you'll be a profitable trader. I'm going to review some of the very successful traders of the world. We'll show you not just how many millions you can make, but billions of dollars that are available. Think of it like rain coming down. Money is flowing throughout the world, throughout our country, throughout the whole trading environment. It's real time over the internet. All the countries are connected. It's like a rainforest. How big of a bucket do you have to collect what's coming your way? In a world of abundance, these people that have done this have been very successful in collecting their own buckets of rain. Start with Ray Dalio, Bridgewater Pure Alpha Fund. I was actually interviewed by one of the people from that fund. One of the executives called and did an interview, went about an hour. Interesting group of questions they posed to me. Returned $13.8 billion last year while the average hedge fund was down 5% last year. So very profitable. The lifetime gains of $35.8 billion. This is a very large organization. In the next few slides, we're going to show you how he thinks about the macro global strategy and how he picks his success. He likes to be challenged by his associates. He asks what is really true, and this ability to challenge each other, I think, has created an atmosphere and a culture for this organization, why their success has been there. So he looks at quadrant conceptualization, growth increasing, decreasing, inflation increasing or decreasing. 4 simple questions, 2 types of countries, creditors or debtors. This is where you have sovereign debt ability to print your own money or not. You can read the slides yourself. Pig countries, of course, have been in trouble. Interesting, Brazil is a creditor country with independent monetary policy. And China pegs its currency to the dollar, which impedes its ability to raise interest rates. Most of you know about George Soros. You probably don't or may not agree with his politics, but his lifetime gains have been $31.2 billion. Jim Rogers, very well-known commodity trader from that. Several other traders have come from that quantum endowment fund. Paulson came to recognition during the financial crisis several years ago, and he had one of the largest trades ever recorded, making billions of dollars. However, last year his hedge fund lost $9.6 billion, mostly on a gold trade. That's double the long-term capital management's epic loss of $4.8 billion in 1998. Remember, that's when all the quants got together, PhDs, super PhDs, building a fund that they thought could always have a winning edge and a lot of leverage. They went down with the Black Swan event. One of the very interesting characters in the hedge fund industry history is Edward Thorp. He's author of the bestseller Beat the Dealer, a winning strategy for the game of 21. The reason it doesn't say winning strategy for blackjack is because his co-author was Claude Elwood Shannon. Dr. Shannon, now deceased in 2001, is best known for inventing the digital computer, information theory, digital and design circuit theory. He was a professor at MIT. Edward Thorp, who started out at UCLA, moved to MIT, and he wanted to meet Shannon. He called Shannon's secretary. She said, well, he probably doesn't have much time for you. Might spend 5 minutes with you, but made him an appointment anyways. Once they started talking, Thorp had a paper he wanted to publish about Jack Black, and for some reason their minds connected, and they spent several hours together. Then they started to cooperate together and produced a paper. The reason Thorp had sought out Shannon was he was the only member of the National Academy of Sciences in that area that was approachable. At any rate, they go together and they put a roulette wheel in Thorp's basement, borrowed a strobe light from the MIT lab, and did a series of experiments. They found that there was a 44% edge by predicting where the ball would land on the roulette wheel. So then they built a microcomputer, and Thorpe wore the computer and the timer with Shannon. They went to Vegas, and betting just dimes, a series of dimes, they established their 44% edge and successful strategy. They went on to publish the book. It was the bestseller, Beat the Dealer. Because of his success and because of his problems with Las Vegas that you could be taken into a back room and beaten up rather badly, he decided the financial markets, despite the beating he might get there, was the place to go, and he did. He developed his own hedge fund and ran it for a number of years, a very powerful hedge fund. And he used an option pricing model using convertible bond arbitrage, combination corporate bonds, and call options with great success. He used mathematical models including the Kelly criterion for his bet size and placement. Our experience at Summit Capital is that one of the most important things you do as a trader is limiting your bet size. We use a 2% rule on our bet size as far as all of our trade placements and continue to manage our money with good stops and complete discipline in terms of having written out and written trading rules. So, what's happened with individual equities? More and more of the individual public, the buy and hold strategies continue to die. How long this bear market is going to consider? My opinion, till the price-earnings ratios get down to single digits, there are about 14.5 right now. It may continue for another 3 to 5 years. I use a lot of Dow theory. Right now, we're on a Dow sell signal. We have not had a new buy signal. We recently reviewed the components from Transport Index, the trucking industries, and they have not yet broken out. So global macro strategies, if you design your own portfolio, would include domestic equities, international equities, inverse equities, currencies, commodities, real estate, and fixed income. The biggest trend is going for professional asset management within the 401ks. Many people are turning to money managers such as Dr. Wills for their help with setting up their own portfolios using this type of strategy we're outlining today. This is state of the art what is going on right now. The uniqueness we have at Summit Capital is our own timing strategy, which we're very proud of. And we're happy to share this with you on an individual basis. If you don't have this book in your library, you need to go to Amazon.com and see if you can buy it used. It's published a number of years ago by Stan Weinstein. One website that we use a great deal is by Eric Wish, wishingwealth.com. He uses Stan Weinstein's classification of stages 1 through 4 of the stock market. Of course, you want to buy your stock as they exit stage 1, all through stage 2 you want to hold, and then as it starts to go into stage 3, be a seller for your largest gains in catching the trends. Stan Weinstein's advice in Wall Street is highly, highly prized. He writes an investment newsletter that sells $60,000 a year to his institutional investors. That this topic is timely is certainly evidenced by recent offerings. There's a new ETF built on stocks from the top hedge funds called Top Guru Holdings Index, started trading just in June of this year. There are other similar ETFs that have been released recently. So some of the competitors to Guru are HDG, Hedge Multi-Strategy Tracker, Alpha Clone Alternative Alpha ETF. These use both long and short position exposures. More expenses up to 0.95% expense ratio. Another fund available is ETF Global Tactical Asset Allocation Strategy from GRT Capital Partners. It goes without saying there's a market uncertainty and complexity. You have to have discipline, systematic quantitative tools, timing asset classes, and major markets. This particular fund uses 14 asset classes, most of them being either equity or fixed income, but it throws in commodity, real estate, and cash. Now, if you're completely lazy and you don't want to manage your time in the market and you only want to spend once a year looking at your market, here's a simple strategy for you called the Lazy Portfolio. You can read the screen. It doesn't have any market timing, using the power of compounding to make it work. There are the returns. Not much better than the S&P 500 over the 10-year period of time. S&P 500 returning 6.85% despite the huge drawdowns of 2008. Greatest fund return on that was at 7.17% in 10 years, which looks like was second grader starter. This book, Buy, Don't Hold, I suggest that you put into your library. It's by Leslie Masonson and it outlines a very interesting strategy. In the book, he uses 8 different indicators to time the market and uses the relative strength indicator for his markers. Right now, he's simplified this called a streamlined dashboard, where he uses only 4 of the original 8 dashboard indicators. Indicator number 2 is the NASDAQ Composite Index 100-day moving average crossover. Indicator number 5 is the NASDAQ Composite Index MACD crossover. Indicator number 6, AALL Weekly Investor Sentiment Survey Bullish Percentage. Indicator number 8, the NASDAQ NASD Summation Index 5-day EMA crossover MACD confirmation. He blogs weekly and gives these indicators for you so you don't have to plot this yourself. You can go to his blog, which is available to you on our reference sheet. We have the blog on the buydon'thold.com category on the website. These references will be available to you. If you want something even simpler, Crazy as a Fox Harry Brown, who's been around for years, has safety, stability, and simplicity with a permanent portfolio that invests for prosperity, inflation, recession, and depression. Very simple entry rules. 25% in each portfolio asset class, rebalancing only once a year if the asset goes beyond 35% or 15% of the portfolio. Here is the chart on this. And one more chart comparing the Vanguard 500 Index. If you want a free screener, go to etfscreener.com. And I recommend that you do screen with the relative strength and your own timing indicators that you find work for you. One portfolio we're currently interested in, we have listed as the 13, includes the diamonds, EEM, EFA, etc. That is also available to you. I would trade off these for your charts, your moving averages, or other indicators. Fibonacci retracements, whatever you find works well for you. This particular day, we screened for 7 over 27. It showed all greens except for one red for that portfolio. If you want it more complex, up to 26, another 13, throwing in agriculture trust, some gold, silver, some international markets, Brazil, emerging markets, semiconductors, financial select SPDRs, etc. So what mistakes can you make? Of course, the biggest mistake is letting emotion get involved in the investing process. That's why we have written out buy-sell rules, rules for systematically discipline for all of our decision-making within the marketplace. How and when to enter the market, how much to buy, and when to exit. And that's probably one of the most important rules that you have to learn. No one runs a perfect trading program or has 100%. You have to be willing to take your losses, small losses, and let your profits run. I'm going to point out 2 screening websites for you. Dark-liquidity.com. It's a free website and it's very useful. I find even more useful a paid-for website, etfreplay.com, where you can do your screening and you can see what the backtesting shows as far as returns. I recommend that you print it out and use all of the references that we have marked up for you. There's one paper from Dorsey Wright that's on there that is particularly useful when we use academic backing as far as the construct of the portfolios, and it also does some Monte Carlo testing. It's very robust and it has excellent academic references that support what we have been talking about today. In conclusion, I want to thank you for your attention, and I want to wish you every success for your investments. I'd like to conclude with one of my favorite poems on success. Success is the way you walk the paths of life each day. It's in the little things you do and the things you say. Success is not in getting rich or rising high to fame. It's not along the winning goals which all men hope to claim. Success is being big of heart, clean and broad of mind, being faithful to your friends and to the stranger kind. It's in the children who we love and all they mean to you. Success depends on character and everything you do. To each of you, success and every good day trading. Thank you for listening.